The U.S. government has blocked a $200 million ethane shipment to China, shaking global energy markets. The Commerce Department's Bureau of Industry and Security denied export licenses for 3 large cargoes set to leave Texas. Enterprise Products Partners, a major U.S. energy firm, was at the center of the disruption, unable to ship 2.2 million barrels of ethane. This move marks a sharp escalation in U.S.-China economic tensions, signaling that energy exports are now a strategic tool. Ports descended into chaos as massive gas carriers like the Pacific Ineos Grenadier sat idle, unable to load. 13 tankers scheduled for China in June were suddenly left in limbo, creating a logistical nightmare. The U.S. action is widely seen as retaliation for China's earlier restrictions on rare earth metal exports, vital to American tech and defense. This tit-for-tat is deepening the economic rift, making global trade more unpredictable. Businesses now face mounting uncertainty, with supply chains disrupted and future planning thrown into doubt. The world is watching as the 2 largest economies weaponize trade, raising concerns about the stability of international commerce. Ethane, a natural gas liquid, is crucial for making plastics, used in everything from packaging to car parts. China's booming manufacturing sector relies on a steady, affordable ethane supply to fuel its petrochemical industry. The U.S., thanks to its shale boom, became the world's top ethane exporter, while China became its biggest customer. By 2025, China was importing nearly 290,000 barrels of U.S. ethane daily, almost half of all U.S. exports. This trade supported jobs and industries on both sides, creating deep economic interdependence. The sudden halt is a direct blow to a multi-billion-dollar supply chain. Notably, U.S. propane exports to China, about 360,000 barrels per day, remain unaffected, highlighting the targeted nature of the ethane ban. The U.S. is applying pressure precisely where China is most vulnerable, its industrial expansion. This selective approach underscores the strategic intent behind the move. Ethane trade was more than business. It was a symbol of cooperation now fractured by geopolitics. The disruption exposes the fragility of global supply chains built on mutual trust. Both nations now face the challenge of adapting to a new, more uncertain trading environment. The world's economic giants are redefining the rules of engagement, one shipment at a time. On May 23, 2025, the U.S. Commerce Department introduced a new rule. Exporting high-purity ethane to China now requires a federal license. This marked a dramatic shift from previous, less restrictive policies. The official reason? National security. Concerns that ethane could support China's military-industrial complex. The licensing system gives Washington the power to approve or deny shipments at will, turning a once steady trade into a political lever. Initially, similar restrictions were considered for butane, but those plans were dropped, highlighting internal debate over how far to go. Ethane was singled out as the key pressure point. The U.S. dominates supply, and China is deeply dependent. The new rule was enforced swiftly, with the $200 million shipment denial serving as a clear warning. For U.S. companies, long-term contracts are now hostage to shifting political winds. The message is clear: security trumps economics. In this new era of trade, the U.S. is willing to disrupt lucrative business to gain leverage over China. This move has upended the playbook for American exporters, who must now navigate a volatile regulatory landscape. The ethane blockade is a calculated gambit in a broader strategy of economic containment. The stakes for both sides, and the global market, are higher than ever. American energy firms like Enterprise Products Partners and Energy Transfer, who invested billions in export infrastructure, are immediate casualties. Stock prices for these companies dropped, reflecting fears over lost revenue and market instability. Excess ethane, unable to be exported, is now sold domestically at lower prices, squeezing profits across the U.S. natural gas industry. In China, petrochemical giants like Satellite Chemical face halted expansion and potential plant shutdowns, as their business models relied on U.S. ethane. Stock values for these Chinese firms also tumbled, signaling deep concern over supply security. If the blockade drags on, Chinese factories may be forced to switch to pricier alternatives like naphtha, raising production costs and reducing competitiveness. Job losses and economic slowdowns loom on both sides of the Pacific. The ripple effects of this single policy decision are squeezing industries, workers, and investors alike. The ethane standoff is a stark reminder in a globalized world, trade wars have no winners, only collateral damage. As the US steps back, Canada and the UAE are poised to fill China's ethane gap. Canada, with vast natural gas reserves and new Pacific export terminals, is racing to become China's next major supplier. The US blockade accelerates Canadian infrastructure projects and opens doors for long-term deals. The UAE, diversifying beyond oil, is also ramping up natural gas liquid exports to Asia. For China, turning to Canada and the UAE means diversifying supply and reducing reliance on any single country. This shift could permanently alter global energy trade routes. Analysts warn that once China builds new supply chains, US exporters may struggle to regain lost ground, even if politics change. Trust and long-term contracts are hard to rebuild in the energy sector. By politicizing energy exports, the US risks its reputation as a reliable supplier. The global energy landscape is being redrawn, and America's rivals are ready to seize the moment. The ethane blockade is the latest escalation in the ongoing US-China trade war. Previous battles focused on tariffs and tech. Now, energy is the new front. China had previously exempted US ethane from steep tariffs, underscoring its importance. The US move to block exports, even during a trade truce, signals a hardening stance. This is part of a broader American effort to slow China's industrial and military rise. The US now views economic ties through a national security lens, prioritizing containment over cooperation. The gamble that China will suffer more than US companies and that allies will follow America's lead. But the risk is real. America's reputation as a trading partner is on the line. The era of open globalization is giving way to strategic competition. Global supply chains are now battlegrounds where energy shipments can be as powerful as sanctions. The world is watching to see who blinks first. These high-stakes decisions ripple down to everyday life. Ethane is the starting point for countless plastic products. If costs rise, so do prices for food packaging, electronics, and more. US Gulf Coast communities and Chinese factory workers both face job uncertainty as exports falter. The disruption exposes the fragility of global supply chains, built for efficiency, but vulnerable to political shocks. Companies may shift to local production, but that could mean higher prices for consumers worldwide. The ethane conflict is a reminder. Global economics is about people, not just numbers. The choices made by leaders today will shape the stability and cost of tomorrow's world. For ordinary people, the impact will be felt at the checkout and in the security of their jobs.